On our last show, we spoke about how individual investors seem to be a lot more negative these days as compared to really any other time that I've been in business. And I've been in business through many downturns in the market, COVID or financial crisis, tech bubbles bursting, etc. But I seem to get a lot of negativity from investors lately on many things. And that negativity maybe is also coming from analysts. We've heard a lot of analysts recently talking skeptically, it's hard to say that word, skeptically about the markets. And the reason for that is whenever an analyst looks at the overall market, let's take the S&P 500, they look at what the earnings per share of the companies trading on the S&P 500 will be for the coming year, $220, $200, etc. And then they like to slap a multiple on that, a premium, if you will, 18 times, 19 times, 18 times, 17, 18 times is usually the average. And so what you find is when you do that calculation, you usually get an S&P or you get an S&P number somewhere around 4,000. Well, today, the S&P is trading above 4,100. So a lot of analysts, investors that do this type of calculation are saying, we think the market is at best fully valued and maybe even overvalued. And therefore, maybe we don't see how much more the S&P 500 can go higher. And you could see how well the S&P has done over the first 3-4 months of this year. And the TSX has been no different. So analysts continue to be skeptical, more so based on a numbers basis versus anything else. But as we know, the stock market, or the S&P 500, let's say the stock market, is a market of stocks. So even though the market in general may be fairly valued or perhaps overvalued, the stocks within the market may not be. There will be pockets of strength within the index, within the stock market, that can still move higher. And this is what analysts seem to forget when they go on TV or they go online and they tell you not to be a buyer, they tell you to be a seller, to go to cash or whatever they're saying. They forget that you could still make money even in a sideways market. The Dow Jones between 2000 and 2009 crossed the 10,000 point mark 6 times, to the up, to the down, to the up, to the down. So if you own the index, yeah, you didn't make much money. But if you own stocks within the index, you actually did very well. So again, it's about picking the right stocks and understanding the investments themselves, what is good quality, what is trading cheaply, because even if the economy is slowing, you could still make money today.